I got to cut to the chase. You moved to Hong Kong. How's Hong Kong doing?
So far, so good. I can't speak for what they think of me, but I'm quite happy there.
Do you feel restricted in Hong Kong? I mean, we get all the news and Curran giving us wonderful briefs as well, yeah. Stephen Engel reporting, but do you feel restricted day to day within the new Hong Kong?
No, it's actually it's possible to move around quite freely. People are wearing masks, but it seems to me that we can do what we need to do. And so I think some of the view from outside may not be consistent with what we see inside Hong Kong.
Into the weekend, let's do something for those that are learning fixed income. Many of our guests say devolve down and look at the inflation-adjusted yield. Should I be looking at the real yield or should I study the nominal yield?
Both, but the one piece that's missing there is the forward real yield. I heard you both talking about it just now. The 5-year forward real yield. So let's take the 5-year forward 1-year rate. It's moved from about minus 150 to plus 100 in the last 6 months. So that's a 250 basis point move. Now you can take that from tips. It's a forward estimating where we're going to be in 5 years' time. Now that says to me there's been a big tightening that you can't see in the spot. So the spot moves by less than that. So from the Fed's point of view, and they look at things like this, they'll look at the forward break-evens, the forward real. It's a bit of a worry because, strangely enough, the market has tightened a lot for them already. And they've only done one small 25 basis point rate hike and a 50. That's all they've done. And they're nowhere near neutral on that basis, but the forwards are already saying that they've tightened.
Are you saying, Stephen, this is really important, that the Fed will not be concerned by a loosening in financial conditions this week, that it won't necessarily alarm them, it will just be a pause in the incredible tightening that they were getting concerned about?
Yeah, from my perspective, I'm a bit concerned because we're forecasting lower yields by year end. We have a 2.5% 10-year Treasury forecast, and I'm a bit worried that it's happening too soon. And to answer your question, Lisa, that's also consistent with the financial conditions not tightening further. Now, they have already tightened quite a lot, to be fair, but the Fed's not well served by the market softening up the financial conditions. And then, they want you all to think that they're hawkish and they're going to hike like crazy. Then you'll behave and the consumer will calm down and the inflation will gradually fall back to target over a few years, right? Yeah. That's what they want. The trouble is we want everything now.
Which is the reason why, and if you go now, it changes the behavior later in the year. If we see an ongoing return to sort of frothier conditions or perhaps the buying the dip kind of mentality, where would you take the 10-year projection for the end of the year if it is currently now 2.5%?
Yeah, I don't think it's going to be quite so binary. I'm sorry if I'm complicating this, but I think it's important to understand. If they hike with their eyes closed and they carry on doing it into next year, then the 10-year Treasury should be 4%, right? If they take into account that we could have a recession by 2024, they're going to be back at zero within the next year or so. Therefore, the yield should be below 1%. So the trouble is that the 2.5 sits right in between those two yields. Now, the human brain isn't clever enough to cope with that, unfortunately, because we want it all in simple terms. We want a simple base case. We want a path. Everything.
So what do you do with that as someone who has to give projections and forecasts?
That's how markets work, though. Markets are trying to incorporate all available information. It's not like they're going to jump suddenly from being hawkish to dovish. There's a transition that's gradual over time. And so, of course, the growth risks are growing. The inflation risks are maybe peaking. So it's happening gradually.
We do our research here at Surveillance, and one thing that's really important is to understand the last time we had a bond bear market this bad, West Ham was looking at relegation. They had a goalkeeper, Phil Parks, they hired for more money than God. There was 78, 79, and now there's now. Yeah. Have you seen a bond bear market price down like we see right now?
Well, this year's decline in bond prices, so the total return the losses this year have been the biggest on record for 40-odd years. We've had 2 consecutive years like this. It's also, I think, the first time since 1994 when both bonds and stocks have gone down. Now, this is important because it's not just a bond bear market you're talking about. You're talking about a stock bear market and questioning the whole role of 60-40. My view on this is that bonds have repriced sufficiently. And we study things like these drawdowns and the move in the forwards, etc. I think bonds are offering much more value to diversify in a equity bond portfolio now than before.
I want you to speak to people that could care less about the forward market.
Yeah.
Page 14 of your 28-page mid-year outlook. They're in some form of fixed income. They're down 3 years coupon, and they're saying, how do I regroup? What is the thought process in a bond bear market to try to catch up?
You won't get it back this year. And you have that's how you have to think in bonds. It's a slow grind. Bonds aren't about all of the rock and roll that you get in equities and in tech stocks and Bitcoin, etc. They're not the same, right? So bonds are there to be ballast in the portfolio. So Tom, you have to accept it's a down year. But you enter now with fresh cash. And you're getting 3% in the longer end. That's what people have been doing. And if you look in IG credit, you're talking about 5%, 6%.
Yeah, but how many of those buyers who were coming in were from Japan? How many were from China? And I say this because actually on a currency hedged basis, you can get more, or you actually can get less in the United States right now than in Japan.
They won't be coming from Japan because the Japanese curve is steep in the 10-year.
Does that matter?
So, well, it means that their own market works better. Right, so that it means that the hedge doesn't work. They're better off being at home. Yeah, so that's true. Money might be coming from other parts of the world. I mean, you mentioned China. China seems to be slowing down. The question is there a capital flow from that part of the world into the US? Well, it's difficult because the capital account is locked down, but something seems to be happening. So if China is slowing down, then that's important to the Fed as well.
Okay. We don't care what you think about fixed income. The reason we had Steve
I do.
Major in, excuse me, Lisa
come on.
cares. I don't give a damn.
One of the preeminent minds in fixed income.
Also in
who's
Full
been
English
incredible.
Breakfast. Steve Major, would you explain this? I mean,
Really?
you grew up with this. Do people really eat this in England?
Not if you want to live a long time. So
we're both gonna die.
What was the tradition of this? In the Major childhood, what was the tradition
we didn't
of
eat
this?
that stuff. My father may have done, but the thing is it's not good for you. You need to stick to the
Do
the
we
health.
blame this on Churchill? I mean, is this like out of some movie, out of 1946 with Winston with a cigar in his mouth and the third glass of scotch at 7 a.m.?
Yeah, I like your comments about the eggs, though. The fact that they're yellow, that's because they are proper eggs. So whatever you're eating in the States,
Well, they're
I don't
orange.
know. But they're the right colour for, but they're organic.
He says proper eggs, and I miss John so much.